Okay, TalkTickers listeners, let's dive in.
Yep.
Today we're doing a deep dive into the Electrobras Q1 2025 earnings call.
Right.
Our mission: to unpack the latest results and management commentary straight from the source, giving you the key takeaways for this quarter and their outlook moving forward.
And what's really interesting about this call, I think, is how it painted a picture of a company making some pretty significant operational strides while navigating some, let's say, specific, maybe unexpected market challenges in the quarter.
Yeah.
It really highlights where they're succeeding and, where volatility is still a big factor.
That's a great way to frame it.
Yeah.
Let's start with the headline numbers then. How did Q1 2025 look just, on the surface?
Well, Electrobras reported an adjusted loss of 81 million BRLs for the quarter.
So a reported loss.
Yeah.
Okay. But looking past that bottom line number, what were some of the positive movements, financially speaking?
Absolutely. There were several good points. Revenue was up the solid 16%, and they made really significant progress on the cost front. Operational costs dropped 28% compared to Q4 of 24.
Wow, 28% quarter on quarter.
Yeah, and down 8% year on year. A big piece of that was personnel cost savings. That contributed to a total cost reduction of about 143 million BRLs, with personnel costs specifically falling by 15%.
15% drop in personnel costs. That's substantial.
Yeah.
Speaks volumes about those efficiency efforts.
It really does.
And they also saw an inflow of cash from asset sales, right? The thermal plants.
Yes, exactly. They confirmed receiving cash from that partial sale out of an expected, 2.9 billion BRLs.
Yeah.
0.2 billion BRLs has already landed in the bank.
That certainly helps the old liquidity position. And a key point on receivables that often comes up, Amazonas energy default.
Yeah.
What was the story there this quarter?
Big improvement there, actually. The default amount was only 56 million BRLs in Q1 25.
Only 56 million compared to what?
Well, compared to 432 million BRLs in Q1 of 24, so a massive reduction.
Huge drop.
And management linked this improvement directly to the negotiation around that thermal plant sale.
Okay, that gives us the quick snapshot. Reported loss, yes, but strong cost control and much better receivables. Now, let's peel back the layers a bit, get into the details.
Sounds good.
You mentioned the 81 million BRLs adjusted loss. What was the main driver behind that specific number? What pushed them into the red?
The most significant impact came from what they call the regulatory remeasurement of chest transmission assets.
Regulatory remeasurement.
Yeah.
Okay. What does that mean in plain English?
Right. Think of it as a non-cash accounting adjustment. It's required by regulators based on a methodology they approved last year. It's not really about the physical performance of the assets this quarter, but more a mandated recalculation that hits the reported net income.
So an accounting item tied to regulation impacting the P&L rather than some kind of operational failure causing the loss. That clarifies it.
Exactly.
Okay, shifting back to costs again. You highlighted those reductions. Management went into more detail on optimizing PMSO. What is that? And what are they doing there?
So PMSO, that stands for personnel, materials, services, and other operating costs. Basically a key bucket of their operational expenses.
Got it.
They detailed how they're implementing changes to kind of smooth out the seasonal ups and downs they saw, particularly in Q4 of last year.
Right. Avoid those spikes.
Exactly. Their explicit goal now is to get to a consistent cost level near or even below 6 billion BRLs on an annualized basis for 2025.
So that Q1 cost reduction we saw,
Right.
that's intended to be sort of the new baseline they build from.
That's the plan. They explicitly confirm the expectation of achieving a recurrent PMSO figure for 2025 right around that 6 billion level.
Good to see those efforts landing and becoming, recurrent. What about the compulsory loan reduction? That's another legacy item, right?
Yes, and significant progress there, too. They managed to reduce the compulsory loan by 400 million BRLs just in Q1.
400 million.
Yeah, which is nearly a 300 million BRL drop compared to Q1 of the previous year. And on top of that, they saw another 336 million BRLs reduction in settlements, ones classified as sort of possible or remote liabilities.
Okay, clearing up some old items on the balance sheet then.
Yeah.
Now let's look at EBITDA dynamics. You said it saw a slight regulatory adjusted drop.
Correct. About 4% down on a regulatory adjusted basis. Management pointed to two main factors for this.
Okay, what were they?
First, the impact of tariff revisions. Those hit transmission revenues, and that partially offset the good performance they saw in generation.
Right, the usual regulatory effects.
Then second, and this seems more significant for the quarter, were energy trading factors. Specifically, they saw a lower average sales price in the ACL, that's the free contracting environment, lower quarter on quarter. And that was combined with having higher sales exposure in the Southeast subsystem, which wasn't fully balanced out by the volumes they had available up in the North and Northeast.
So this is where that energy trading strategy and those submarket dynamics really start to bite into the quarterly performance.
Precisely. It's a key part of the Q1 story.
You also mentioned operating provisions improving earlier, tied to Amazonas.
Right. They noted ongoing improvement generally in provisions, but the most impactful piece was definitely that reduction in recurring default from Amazonas Energy.
And that links back to the thermal plant sale again.
Exactly. As we touched on, management sees that as a direct positive outcome tied to the negotiation and sale of those specific plants. It helped resolve that long-standing issue.
Okay, moving from the financials to the nuts and bolts of the business operations and strategy. How is the general health and availability of their equipment? Generators, transmission lines?
They reported high availability for both generation and transmission equipment. Management really emphasized this as a key focus, operational excellence and reliability.
Good performance on the ground then, always important. And progress on new projects. Anything coming online?
Yeah, they highlighted the conclusion of the Cochillia plant, which is good news, and continued advances at the Manaus Boa Vista project. They actually expect that Manaus Boa Vista project to wrap up in the second half of 2025.
H2 25. Got it. Any updates on the Angra nuclear plant? That's always a complex topic.
Yes, and they were quite careful in clarifying this. Investments have been made towards finishing Angra.
Okay.
But, and this is the key part, management stressed this is part of the existing government conciliation agreement. It's an old obligation.
Right.
Critically, Electrobras itself will not be putting new money, new investments into the plant.
So no new capital from them?
Correct. They confirm they are continuing the process to sell their stake in Electronuclear, a process that actually started back in late 2023.
So fulfilling a past obligation through that agreement, but actively working to exit their direct ownership and avoid any new capital exposure there, makes sense.
Exactly.
What about expanding their reach? Any news on customers or capabilities?
Just briefly, they mentioned advancements in training internally and also growth in the number of ACL customers. So some focus on both internal capabilities and market penetration in the free market.
Okay. This all brings us quite nicely to what sounds like the key story of the quarter, the energy trading strategy and its impact. What's their overall approach for 2025 in the trading space? What are they trying to do?
Well, for 2025 itself, they're managing a balance sort of between 0 and 2.5 GWs short or long. But their primary focus right now, interestingly, is actually on enhancing their sales position for 2026 and 2027.
Looking further out.
Yeah, they're adjusting their strategy based on changing price dynamics and, well, the volatility they're seeing in the market, which Q1 really highlighted.
And how did that strategy play out specifically in Q1? What was the plan?
Their Q1 strategy was really centered on hedging risk. They basically expected a low price settlement, the PLLD.
Okay, betting on low prices.
Right. And they structured their trading with higher volume contracted in the Southeast subsystem. The idea, the hope, was that the energy they have available in the North and Northeast would balance this out, mitigate the risk of those low prices across the whole system.
So trying to use their geographical footprint, their portfolio, to hedge against that specific low price expectation. But I guess reality didn't quite match the expectation.
Precisely. That's exactly what happened. There was a significant and apparently unexpected mismatch in prices between the Northeast regions and the Southeast region in Q1.
A big gap.
A big gap. And this disconnect is what significantly impacted their results from trading. It went the wrong way for them.
And management was quite direct about this, right? Even saying they're shifting strategy from Q2 onwards because of it.
Yes, they were very candid, actually. They acknowledged that the prices being practiced from Q2 onwards just didn't really align with that previous trading strategy.
So the strategy didn't fit the new reality.
Right. So their decision going forward is to essentially allow more energy to stand without contracts unhedged. The aim is to negotiate when prices better reflect reality, or at least offer more favorable terms from their perspective.
Waiting for better opportunity.
Yeah. And they explicitly stated that the Q1 strategy, quote, was not correct, given the outcome.
Wow, that's pretty notable, that level of candor from management. What price dynamics are they seeing now that inform this shift? Why wait?
Well, they noted that the Q2 onwards price curve has risen significantly. It reached around 360 BRLs per megawatt hour.
Big jump.
Yeah, and the full year dotted curve, which started the year below 150, had also climbed up to around 290.
Okay.
So this changed outlook, seeing higher potential future prices, is exactly why they're less keen on locking in contracts at maybe currently lower spot or near-term levels. They prefer to wait and capture potentially higher prices later.
So this sub-market risk, the price difference between regions wasn't just some minor factor in Q1. It was absolutely central to the results.
Oh, absolutely essential. Management views the mismatch they saw in Q1 as reaching an extreme, like worst case scenario territory.
Extreme, okay.
They do expect the risk to be lower going forward, particularly in Q2. That's partly because they've adjusted their exposure and partly because they anticipate lower levels of mismatch. But, they acknowledge volatility remains, especially in the short term.
And they mentioned something about convergence later in the year.
Yes, they specifically mentioned expecting a convergence of North and Southeast prices around November. That's part of their modeling.
Okay, that's sub-market risk lesson learned in Q1 and their subsequent strategy shift. That feels like one of the most important takeaways from the call for anyone following Electrobras closely.
I'd agree with that. It's crucial.
Let's talk about the bigger picture now for investors. What's the strategic agenda looking like for the rest of 2025? Where's the focus?
Well, following some key agreements, the government conciliation, the collective bargaining agreement, and with increased board stability, management feels they have a clearer runway now.
Less distraction, maybe.
Sort of. The investment program target for this year is pretty ambitious, actually, above 4 billion BRLs. And they're prioritizing their own assets, meaning projects where they already have the environmental licenses sorted and where they see proven returns, investing in their core business first.
Makes sense. And on the flip side, divestments. Are those still happening?
Yes, divestment plans are continuing. Pursuing the sale of their stake in Electronuclear, the Angra operator, is a key example. But alongside investments and divestments, there's this really intense focus now on cost reduction and efficiency.
We saw that in the Q1 numbers.
Exactly. And they're actively comparing their performance to peers and competitors. They stated an explicit goal to become the most efficient company in the sector.
Aiming to be the benchmark for efficiency. That's a bold goal.
Yeah.
How does that translate to their external relationships, like, say, with suppliers?
Well, they mentioned discussions with suppliers are focused on securing competitive costs, naturally, but also high equipment quality. They feel they can leverage their recent success in transmission options where they performed well to negotiate better terms going forward.
Using their market position. Okay. An important part of future growth for the whole sector is capacity auctions.
Yeah.
What's their view on those actually happening?
Management highlighted how important these capacity auctions are for Brazil's energy security and confirmed their expectation that these auctions will materialize in 2025.
So they think it's finally happening this year.
That's their expectation. And Electrobras believes it's strongly positioned. They mention a broad portfolio potentially beyond 6 GW.
Wow.
And the capability to add even more production. So they stated they're ready to participate this year and add significant capacity in the coming years through these auctions.
Okay, turning to capital allocation and liquidity. Always a key question for shareholders. Buybacks versus dividends. What's management's current thinking?
Management currently seems to lean toward share buybacks as a preference, yeah.
Okay.
But they were careful to clarify that their strategy really incorporates both. They operate under a broader sort of midterm methodology, looking 5 years or more out.
Right.
That considers cash generation, investment needs like those auctions and their leverage levels to figure out the optimal way to return capital while still funding growth. It's a balancing act.
And how do those thermal plant sale proceeds we mentioned earlier fit into this framework?
They're part of this broader capital allocation picture, obviously bolstering their cash position. They actually noted that the additional dividend payment they made back in Q4 of last year.
Yeah, I remember that.
That was supported by this forward-looking view, their price expectations at the time, and the substantial liquidity they'd built up throughout 2024. Remember, they raised over 30 billion BRLs and accessed new funding sources last year.
Right, built up a war chest.
Pretty much. So they reassured listeners that capital allocation decisions are carefully balanced, considering future investment opportunities like those capacity auctions, alongside shareholder returns.
Okay, comprehensive approach there.
Yeah.
Finally, let's just circle back one last time to that sub-market risk we spent some time on. Did management detail how they're actively managing it now?
Yes, they did. They explained their portfolio balancing strategy, roughly 50% southeast, 25% northeast, and 25% north.
Okay, diversifying geographically.
Exactly. And the use of swap operations as tools to mitigate that regional price risk. Based on their analysis and the strategy adjustments they've made since Q1, they expect the mismatch impact in Q2 to be lower than what they saw in Q1. That's due to reduced exposure and also lower anticipated mismatch levels going forward.
But still some volatility expected.
Oh, yeah, they definitely acknowledge volatility remains, especially short term. But that expectation for convergence of north and southeast prices around November is still a key part of their outlook for managing this.
Okay, we've covered a lot. The numbers, the operational details, the strategic priorities, and that really critical energy trading dynamic from Q1. Now for our final segment. Ready? This is not financial advice.
Definitely not. Caveat emptor.
But given everything we've just unpacked, management's very direct comments about the March Q1 submarket mismatch being an extreme event.
Right.
Their stated expectation for lower mismatch going forward, that price convergence idea, especially north-southeast towards November.
Yep.
And their pretty significant shift in trading strategy, moving away from hedging low prices to allowing energy to stand uncontracted, hoping for better future negotiation.
Here's a slightly outrageous, maybe, but plausible idea to mull over.
Okay, let's hear it.
You could consider a relative value trade, perhaps taking a short position on the southeast power price differential versus the northeast north power price.
Interesting. So betting on the gap closing. Exactly. The thinking would be you're betting on that convergence management discussed. You're anticipating that the Q1 mismatch was indeed an anomaly, or at least unlikely to repeat with the same severity in the near term, especially now that they've consciously adjusted their strategy and portfolio positioning to be less exposed to it.
It certainly leans directly into their explicit commentary about future expectations and lessons learned.
For sure. It's definitely vital, as they themselves noted multiple times.
Oh, yeah.
But it directly plays on their narrative.
Keeping in mind, as they pointed out, that volatility in these specific submarkets is kind of an inherent characteristic, particularly over the short term. It won't be a smooth ride.
Absolutely. A crucial point. So to wrap things up then, Electrobras is navigating Q1 with a clear strategy shift, particularly in trading. While they reported that adjusted loss, driven largely by a specific regulatory item and hit by significant market volatility.
They also demonstrated some substantial operational improvements and, importantly, those significant cost reductions we talked about.
Right. Management laid out what seems like a clear path forward. Focus on increasing investments in their core high-return assets, continuing with strategic divestments like electronuclear, and really aggressively pursuing efficiency gains with the aim of becoming a sector leader.
And those energy trading challenges in Q1, they clearly served as a lesson, prompting that strategy adjustment they believe will yield better results as, hopefully, market dynamics stabilize or at least become more predictable.
And just to reiterate, this discussion is based directly on the company's own statements and beliefs shared during their earnings call.
Yeah.
It highlights the company focused on, well, disciplined execution, careful capital allocation, and actively learning to manage these complex market risks, like those regional price differences.
It certainly raises the key question for the coming quarters. How effectively will these strategic adjustments, particularly in the trading book, actually translate into performance? How successfully can they capture the potential upside if prices do rise, as they seem to anticipate, while mitigating that submarket risk that bit them so hard in Q1? That's definitely something worth considering as you look deeper.